So in today's video, I'm going to give you a little tip. Don't tell everybody because this is not something that everyone knows. What is this tip? You can use a loan from a family member for an FHA down payment or source of funds. You hear me? All right, so stay tuned and let's talk about this. What is a down payment and what are some acceptable sources of down payment and or closing cost? So what are acceptable sources? The acceptable sources are, your own funds that we can verify the deposits on, and that we have 1 to 2 months of bank statements to show, along with transaction histories, what your deposits are. A lot of times we are getting bank statements and there are a lot of different deposits, okay? When we talk about a loan, we look at 3 things, okay? We look at income, assets, and liabilities. In this video, we're only gonna address assets. So as I mentioned to you, this is something that you have in your own bank. It's something that can be proven. If you sell something through, let's say, Facebook Marketplace, or you had a yard sale, we just need to make sure we document everything, okay, on the cash deposits. In situations where funds cannot be documented and we have to back out funds, because within those 1 to 2 months of bank statements that we need, it shows a large deposit that cannot be sourced, we may have to resort to either a gift, and in this instance, a loan from a family member. Now, keep in mind, this is only going to be good for FHA loans. This is not going to be good for all the other different loan products. We're specifically addressing FHA loans because FHA loans have a lot of favorable things that just happened. Number one, it's a low down payment loan. 3.5% down. A lot of times we do have some down payment assistance programs that kind of work with it, where you're taking a little higher rate. However, you're going to have your down payment covered and hopefully the seller will cover your closing cost. The other benefit of FHA is that a lot of the loan level pricing adjustments have been readjusted. So it's even more affordable because the government and the Federal Housing Administration and everyone else, they're trying to make it so that the housing is going to be way more affordable for people that want to have these properties as their primary residence. They're going to reside in the property. So anything that can be done to, make it so it's more affordable is what the FHA is trying to do. What if we come up with a situation where we can't get a gift, we don't have any more money that we can tap into from your bank accounts, any stocks, bonds, mutual funds, 401ks, TSPs, or anything else? That's where we're talking about getting a loan from a family member. The guidelines that go along with this specific guideline, it's very specific, okay? So it's not something that you're going to find on a bunch of YouTube videos or you'll be able to Google and find it, is that the loan that you're getting from the family member must be disclosed on the application. That's number one. When we're going through the asset section of your loan application, we have to disclose that you are actually getting a loan. The loan can be secured or unsecured. So an unsecured loan means that, hey, they're just lending you the loan or lending you the money, and then there's not anything as a security instrument on it, so you don't lose anything if you don't pay it back. However, if it is secured by personal property or something of value. It could be jewelry, it could be firearms, it could be a golf cart, it could be a rare card or whatever it may be. It can be secured against the subject property. And if there is a lien, the lien on the property must be a family member lending the monies, not a third party. So it has to be, it could be a second mortgage basically that you have to pay back if it's secure. It has to be under the FHA guidelines as an acceptable family member, and i.e. where it came out of their financial institutions, we can document the money being there and taken out. The institution can also place a lien on, let's say, your family member's property. So your family member could go out, borrow the money, secure it against their property, but it cannot be the borrower's subject property. So it cannot be the property that you're looking to buy. And the borrower cannot sign the note with the financial institution. So if they're borrowing a personal loan at ABC Bank and they're using that money for your down payment, then you cannot be a co-signer on that or have any signing authority or have any type of liens against your property. The sources of funds that your family member is going to be using for the loan, it cannot be directly or indirectly from anybody with a financial interest in the transaction. So they can't take a loan with your loan officer as a second, because they have a financial interest in the transaction. It can't be taken from the real estate agent or anyone else. It has to actually be an actual loan, either from a bank, lending institution in their accounts, or like a retirement 401k loan. If there are payments on it, since this is a loan, we are going to have to count it against your debt to income ratio. So we have to have the loan agreement or the note to show what the monthly payment is, because that is going to be counted against your debt to income ratio. And it has to fall within FHA guidelines. And typical FHA guidelines are going to be 31/43, 31 on the front end, back end 43. However, if we go through manual underwrite, then there's going to be specific guidelines and or compensating factors that have to happen. Compensating factors are, no payment shock, maybe a couple months of reserves, other sources of income that cannot be documented, so on and so forth. So there are a list of compensating factors that come into play. And that's something that if you want to comment below and you want to know more about the compensating factors, we can also let you know about that. There cannot be a balloon payment on it. So what a balloon payment is like when you're making the monthly payment on every single month, and let's just say it's amortized over 30 years on the payback, okay? And we'll just use simple math, $30,000 as a gift or a loan, and then you have $100 a month over 300 payments. That payment cannot have a balloon feature on it where it says, hey, even though we're amortizing this over 300 payments, there cannot be a due on sale clause or a balloon payment which says, hey, at the end of a certain period of time, let's say 10 years, you have to pay it all in full. The combined loan to value, which is your loan, which is 3.5% down, that takes the loan down to 96.5. You cannot borrow more on a loan to exceed 100% of the value of the home. So it cannot be more than that 3.5% down. If they're going to give you, let's say, 10%, then you could apply the full 10% towards a down payment to maybe have better and more favorable terms. Maybe you can repay it at a lower interest rate. That would work. And then the first mortgage amount calculations are not affected by this, okay, in any way, shape, or form. So the first mortgage is the FHA loan that we're giving you only. If we're going to count the second mortgage, that's going to be on its own. It's going to take second lien position. The first mortgage takes priority in first lien position. This is a little known secret that a lot of loan originators don't know about. This is a guideline that is a little different. However, if you have any questions or concerns, you can feel free to reach out to me and my team. My name is David Xie. I can be reached at 757-478-8493, and I will help you guys and talk to you later. Thanks. Bye-bye.